Hello, everyone, and welcome to Sipping Wealth Live. Yay! So, this is another episode of Sipping Wealth Live, like I said. Um, this week, we are going to be going over some tax planning strategies for individuals, for your personal taxes. So, I'm going to go over some amazing strategies that you can employ in 2024 to make sure that 2024 is that year, because who wants to overpay in taxes? No one, right? All right. For those of you that are tuned in with me, go ahead and drop a comment in the comment section. Say, hey, something. Hey to your girl. Let me know who's tuned in with me. And also be sure to head over to the Sipping Wealth YouTube channel and hit the subscribe button so that you don't miss out on any Sipping Wealth lives, as well as make sure you hit that share button so that you can share this live with your friends, family, loved ones, so we can wealth up together. All right, y'all, I'm going to go ahead and get it popping in this topic tonight. If y'all have any questions, per usual, while we're live, be sure to drop it in the comment section and make sure that you are sharing. All right. And hit the like button, the love button, engage with your girl. All right. So to get us started, so today, like I said, I'm going to be talking about these some smart personal tax planning for 2024. So this is definitely a time to make sure that you're taking your notes. You're maybe even rewatching this, because these are things that you want to keep in mind as you go throughout the year. So for starters, I'm going to talk about the standard deduction and the tax brackets for 2024, because I want to make sure that you're all aware of this. Hey, where the bracket system, what is it looking like for the next year, so that you're aware. Also, for those of you that are behind on your tax bills, things like that, estimated tax payments are due January 15th. This is the last one. You do want to make sure that you are up to date in it. The IRS can now charge up to 8%, on the amount of money that you owe to them, which could be pretty hefty. All right, y'all, you don't want to overpay. At all. Okay, so I'm gonna go ahead and share my screen. All right, so that I can show y'all directly from the Internal Revenue IRS website. We are going to look at those the rates, standard deduction, and the tax rates brackets for next year. So as far as the standard deduction, so for my married individuals, we have our standard deduction at $29,200, a $1,500 increase, like it shows here, from 2023. All right. So this is they actually increased this based on inflation. Um, what their standard of inflation, so that it accounts for the changes of the dollar, the standard of living, things like that. For those that are filing single or married filing separately, you're looking at 14,600. And then for those that are filing head of household, you're looking at $21,900. Okay, and then these are your income tax brackets for 2024. So we have the lowest being the 10% tax bracket, and that's that first $11,600 that you earn. So again, the first $11,600 that you earn of the year will be taxed at 10%. Then the next 11,600 and up until 47,000 is going to be taxed at 12%. And that's how the bracket system work. So when people are trying to calculate their taxes, you don't say, oh, I make $100,000. I'm going to tax the entire 100,000 at 24%. That's not how it works. It's like a leveled system. Okay. So depending on where that money falls in the levels, it determines how much that group of money is going to be taxed at. All right. Okay. Let me stop sharing. Okay, hopefully that makes sense. Yeah, let's keep it moving. So my first tip for you all is going to be your retirement contribution. So you actually have until April to max out your retirement contributions for this year, for 2023. So if you find that, hey, oh my gosh, I'm gonna be hit with a tax bill, Do you want to pay to your future, or do you want to make sure that that money goes to your retirement? I mean, do you want to pay towards your future for your retirement, or do you want that money to go to the IRS? Okay, so it's like choose your side. So you might as well make sure that you max out your contributions for the year for retirement contributions, so that you don't have to pay extra money to the IRS when you could be taking advantage of that for your future savings. I'm going to share my screen again. All right, and we're going to look at the contribution limits for next year. And then this article will also show, I'm going to drop the article in the comment section for you all. All right. Oop. Okay. Okay. So just in case y'all want to look at this article later on, you can check this out, both of these articles. Okay. So all right. So for the changes as far as your contribution limits and for 2024, you are up for those that have employer plans for your 401k, 403, or government plans or things like that, their savings. So you do have a $23,000 limit for that, which is an increase. But for 2023, your last paycheck was probably already put in. So probably leave it at. But you can still make sure that you are contributing to your IRA account. So your IRA account, the max for 2023 is 6,500. So if you know you didn't max out your retirement plan and you're about to owe the IRS for 2023, go ahead and take advantage of this max. It's not going to take out dollar for dollar. If you owe the IRS 8,000, it's not going to reduce your tax debt to 2,000, but it will help reduce it to a certain amount so that to a smaller amount, because it's going to decrease overall your taxable income, and then it's going to help put towards your retirement savings for the future. All right, so that is an incentive. Next year in 2024, so the IRA contribution limits are 7,000. So again, like I said, this is, go ahead and do your retirement savings. You might as well take advantage of it because it's better you pay out to your retirement plan than not to then have to pay out in your taxable income. Pay out have your higher taxable income. All right, the second thing I want to go over is your HSA or your FSA. So HSA is going to be your health savings account, and then your FSA is going to be your flexible spending account. Your FSA is going to be through your employer. Your HSA, you can go ahead and set that up on your own. Self-employed individuals, you can do it. You can open up your HSA on your own. You don't have to wait on your employer to set up a health savings plan for you. Okay, so this is beneficial because this is pre-tax dollars, meaning if you fund this account and you spend the money that's in that account on health things, health related things, then this is pre-tax dollars. Like I said, this is money that haven't been taxed, that on stuff that you're going to have to purchase anyway. So you might as well go ahead and fund your HSA account pre-taxed. Use that money to go ahead and pay for those medical things that you need. There's vitamins. There's you can even use it towards some things on Amazon that are HSA approved. So depending on what they are, you can go to your local pharmacy, go on Amazon, whatever the case may be, and it may be HSA approved. A lot of the times they will say HSA, approved on it. If you have that question on whether or not it's a qualified expense for that account. But like I said, this is tax-free dollars. So this is stuff that you're already going to be spending on. So you might as well use pre-tax dollars on it. Okay. For my self-employed individuals, you can go ahead and this is great. You can manage it on your own. Huge savings, huge deduction as far as your a company setting this up. I shouldn't say self-employed. For my business owners that are employed by their businesses, this is great incentive as well, because there's that deduction standpoint for your employees. All right. My next thing I'm going to talk about is your different efficient investment and strategies. So I did go over last week different tax loopholes for my small business owners, things like that. I know my individual folks have to deal with long term and short term capital gains as well. So I know outside of small business owners, you are dealing with it as well. So when you're dealing with capital gains, you're looking at essentially two different buckets. You're looking at a passive income bucket, and then you're looking at your non passive bucket. So the two different buckets, you can't mix them together, right? So your passive stuff is going to go towards your passive losses. So that's your stocks, maybe you're trading, maybe you sold an investment property, things like that. And then your non-passive, that's your self-employment income. That's your W-2 income. That's non-passive. And those can go, those can help out each other. So that's why a lot of my self-employed folks with a Schedule C, when their business is at a loss, it decreases their total like ordinary income, their non-passive income, and it's hitting it dollar for dollar. Versus on the passive side, you have that stop limitation, that $3,000 max, right? So things that you want to be aware of is, hey, different strategies and things that you can employ to help with decreasing that capital gains hit. Maybe instead of selling that property within a year and paying at a short-term capital gains rate, which is essentially the ordinary tax bracket rates, maybe you want to hold it for another month, and then now it's in the yeah, it's a long-term capital gains property or capital gains rate, so that you have that cap and you're not being hit so hard as far as the tax bill. Um, so, or maybe you want to do a different strategy. Maybe if you're selling property, you want to do a 1031 exchange. So you can actually defer the capital gains taxes on that property. You can also do a uh, installment sale. So not getting paid the entire thing all at once. So these are different things to help with, your different investments that you're doing, whether it's stocks, whether it's property, things like that. All right. Understanding, next thing I'm going to go over is understanding your and utilizing real estate deductions. So I talked about this last week too, like your home office, your property, even on an individual basis. I'm going to keep it individual. I love business, y'all. Okay. So on an individual basis, if you're itemizing, you can actually deduct your mortgage interest, property taxes. This can help decrease overall your taxable income, and that's a nice hit. So you don't have to necessarily do the standard deduction route. And under the itemized route, you don't have to just say, oh, if I didn't do $12,000 worth of charitable contributions, and it doesn't apply for me. You can use that. I know in South Florida, they're getting hit with heavy property taxes. I just had a conversation with my brother, my mom, a few days ago, and we were talking about the property taxes and how they're ridiculous. 10,000, 11,000. One property's 14,000 in property taxes. Like, so, these are things that you could take advantage of to make sure that you're on your tax return to help decrease that tax bill. All right, and the last one I'm going to go over and open up the floor. Do I have any questions? All right. Okay. So the last one I'm going to talk about is making sure that y'all are staying informed with these tax law changes, things like that. I will be doing this live, like I have been doing every week. So make sure that you are joined every week to Sipping Wealth Live, so that because I'll be making sure that you're informed on these tax law changes. There are so many out there. So you can check them out yourself. Make sure that you're following the page, Sipping Wealth page, but so that you're constantly aware of these different changes. And then now you're bringing it up to the table when you're speaking to your accountant, when you're speaking to your tax professional, because sometimes throughout the year we lose track of what happened. And then we're like, oh, shoot, I forgot I did this. Or, yo, I could have took advantage of that credit had I told my tax professional. So they don't know your life. So unless you tell them what happened or what's going on, they won't be able to properly advise you. So making sure that that you're also aware of these tax law changes. Like, for example, the electric vehicle credit, tax credit. So that one, it got killed in 2022, for your Teslas, certain models. And then they brought it back in 2023. So, for example, if you didn't know that, and maybe you were car shopping, you're like, oh, I'm not going to go that route anymore because they don't have the energy credit for it. Maybe you're like, hey, I'm not going to go ahead and purchase. And you could have took advantage of that tax credit, but you went and got another vehicle that wasn't energy efficient because you thought you wasn't going to get the tax credit anyway. You know, this is giving an example, but making sure that, like I said, making sure that you're informed, about these tax law changes. They do affect you directly. Some of them may not apply for you, or you're not there yet in your wealth journey. But it's good to kind of keep it in mind so that you can make sure, hey, I can employ this strategy in the future because I want to make sure that I'm making this amount of money, or I'm going to be making this amount of money next year. I need to make sure within that year I'm doing this so that I'm not hit with tax strategy. The whole thing about taxes and reducing your tax bill, people are like, they always say, like, I want to pay $0 in taxes. How do I get there? Like, how do I get the Trump special and pay no money in taxes? Da da da. Or these other people, these other millionaires and billionaires, how are they, having these low tax bills? And it's because they have tax strategies that are being built at the top. Like, their strategy for next year was done in third quarter of this year. That's how in advance these tax strategies are being built out. Like, by fourth quarter, like, your strategy for next year should be sealed, ready. So people that come and they come to me in September, October, November, and they're like, oh, how do I decrease my tax bill for this year? Well, it's so late in the game that it's going to actually hurt the amount of things that we're able to do. I had one person a few weeks ago, one client a few weeks ago, and she's like, hey, I'm about to be hit with a $54,000 tax bill. Like, what can I do? And we are like, I'm working with, my investment advisor. I'm working over here, TPA, and we're coming to the table and we're like, hey, we need to do this, da 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 da, because we need to help my client. We need to figure out how we're gonna get her tax bill down. So, but it's so late in the game, and because her entity was structured a certain way, great, she was able to employ different things. But a lot of people don't already even have that structure set in place. And then you come at November, December, and you're like, oh, I want to save on taxes for this year. You late to the game. You are late. So next year is a few days away. If you haven't sat down and come up with a tax strategy for next year yet, make sure that you do that within the month of January before you even file 2023's taxes. Just go ahead and get it out the way so that you're not coming in at November trying to figure out how you're going to decrease your tax bill. All right. Let me see. How y'all doing tonight? Quiet in the comment section. Okay. So to recap from everything, I did speak about utilizing your retirement accounts, making sure that you're funding it. You do have until April to make sure that it's funded. If you do have that IRA account, it's not too late to open that up either. So, make sure you get that funded. Retire. Also, if you own real estate, taking advantage of those deductions, considering itemized deductions for your tax returns. I did go over that as well. Your investments, knowing the difference between long-term and short-term capital gains, and how to, employ different strategies to mitigate that. I also went over your HSA and your FSA account as well, making sure that you're taking advantage of those accounts. They do not get utilized enough. Okay. All right, got to do it. Okay. And then making sure that you are informed, staying up to date on these tax law changes. Continue to tap in. Stay tuned with me. I'll be going live, like I said, every week. So be sure to join me back live at Civic for another episode of Civic Wealth Live. And next week, we are going to be going over navigating complex tax situations for high net worth individuals. So if you know anyone that's getting money, if you're getting money and you're like, oh, I need to figure out how to wrap my head around all these complicated tax stuff, then you want to make sure that they are on next week's live. They are tuned in to next week's live. And then I'll also be there wishing you all a happy new year as well. So make sure you're tuned. Somebody said, "You're awesome for sharing so much. I'm gonna DM you." That's what it said. Okay, sounds good. Thank you for tuning in. I appreciate you tuning in. Hey. Okay. So yes, be sure to tune in for next week. Thank you all. Thank you for tuning in for another episode. Make sure you hit that share button. Make sure you subscribe to that YouTube channel. And I'll see y'all next week for another episode of Sipping Wealth Live.